Want to pay off your home faster and save thousands of dollars in the process? We're going to cover off on the strategies that you can make this a reality to pay your home loan off faster and discuss the pros and cons of some of these options. We're also going to have a chat about the benefits of paying off your home early or whether you should keep yourself liquid to access investment opportunities. Now, the truth is, whether you're a first home buyer or a seasoned pro when it comes to investing in property, you really want to make sure you pay the minimum amount of interest possible when you're going back to the bank. You want to pay off your home loan faster so that you can create more choices, de-stress, and have access to more choices in life. So let's work our way from the easiest to the most difficult options in these videos when it comes to paying down your home loan faster. And point number one is just to simply make extra repayments. By making these additional repayments, you're going to bring down your principal balance faster. Bringing down your principal balance means you're going to pay less interest and more principal component each time you make a repayment. In addition, you should consider doing bi-weekly payments. This is exactly what Emily and I do. You want to pay every fortnight rather than every month. The more frequent you're making those repayments, the more frequent you're bringing down that principal balance and paying less interest on your loan. So essentially, you're going to be making around 26 payments each year rather than 12 or 13 payments, speeding up the process of paying down your home faster. This leads me into point number two, which is instead of making those extra repayments, let's get a little bit more advanced and set ourselves up with an offset account. An offset account is essentially a standard bank account that sits against your home loan. It allows you to park that money, whatever you've got, $5,000, $50,000, $500,000 in that account and offset the balance that's calculated on your home loan. Now, interest is generally calculated daily. So every day, whatever your bank balance is, the bank's going to calculate daily interest. So say, for example, we've got $200,000 in our bank account. We could be parking that against our own home, which could say have $1 million of debt, just as an example. And so we're only paying interest on the balance, which is $800,000. Now, it's a teeny bit more advanced than making those additional repayments, but it gives you that extra liquidity because that cash is not sitting in the loan. It's sitting in a separate bank account, which you can use at any point in time. So definitely consider having an offset account generally sitting against your own home. And if your own home's paid off, then your highest interest rate debt. The reason you want to park it against your own home first is because your own home is non-deductible for tax purposes, meaning you can't claim a tax deduction for the interest you pay on your own home. So you want to minimize that debt. And then once that's paid down, then shift the offset or the funds into an offset account with your highest interest rate debt and start paying that down next. Now we're going to start getting more advanced. So let's talk about the refinance game and how you can use that to restructure and manage your property portfolio or manage your own home. So generally here in Australia, most people will be on a 30-year mortgage. And that means you're spreading out the repayments for your $500,000 debt or $1 million debt over 30 years. Now, what a lot of people end up doing is they start paying down their mortgage like every good Aussie should do, you know. People want to put their money away and pay down the balance over time. And so 3 years, 5 years, 10 years might have passed, which means the loan is being amortized. All this means is the loan balance, the access to capital is being reduced based on the term of the loan. So you could have had the loan for 30 years and you've been paying it off for 10 years. So you've only got 20 years left on the loan. Now, what you could do if you wanted to is you could extend back out to 30 years. This will reduce the amount of dollars you have to repay to the bank. It will increase your interest, but will give you more free cash flow. So you could have been paying $1,000 a week, but when you refinance, you might have to only pay the bank $500 a week. Now, this is counterintuitive to the title of the video. How is that going to help you pay off your home faster? Well, what it's going to do is free up cash flow, which leads me to my next point. Freeing up this cash flow can allow you to invest. And what that means is you can put your money to work rather than paying back the bank at 3%, 5%, 7%, depending on your interest rate. You can use that money and use those funds to try and put it into the property market, put it into the stock market, put it into your own business, and look to grow at a faster rate. If you think you can earn more than, say, 7% each year, you can get 15% returns or 20% returns or double down. You know, if you think you can get higher than a 7% return, then you may as well go put that money to work and then The difference is essentially what you're earning in the market. This is again what Emily and I have done in our property portfolio. We could have bought our first home and just done, the everyday Aussie thing of maximizing the amount of money we put into our repayments, building up our redraw facility and putting as much additional money into our home loan as possible and getting that down to a small figure. But instead, we decided to refinance our portfolio, grow our asset base, and hold a larger asset base. As the market lifts over a long period of time, which I believe the market will continue to do over that long time horizon, then we were able to see that growth and use that growth to our advantage in creating equity and creating cash flow. So we've covered extra repayments, offset accounts, refinancing, and investing. My fifth point is expense management, both from your living expenses and obviously the loan expenses that you take out. If you can create that free cash flow in your life and minimize your expenses, it's going to mean you need to live with less. Being a minimalistic type person, or I don't even know if that's quite a right word, minimalistic, being someone who's not attached to material stuff and needs more fancy things can allow you to save money. Now, I definitely advocate for spending money on certain things. I play football, for example, and I want to spend money on new boots. I really enjoy playing. I spend money on my fitness. I spend money on things that make my life easier. Buying the right tools to improve your productivity and better your life is not a bad thing. But spending money on a Gucci bag or the fanciest iPhone, do you really need the iPhone 15 to the iPhone 16? I don't even know what number there's up to, or X or Y or Z. Do you really need that fanciest piece of tech if you've got something that already does the job and you've had for a year and you don't need to upgrade? Look at reducing those expenses and spend money on your health, spend money on your productivity, and spend money on your loved ones, giving to others. Paying off your home might not be easy, but it's absolutely possible and you can do it faster. Whether you're looking to pay down the debt to give yourself that sleep at night factor, or you want to increase your cash flow in your property portfolio, it's all up to you at the end of the day. If you're interested in seeing how you can turn your own home into a tax deduction, then you should click this video over here. I'll see you in the next one. Peace.